Okay, welcome back. So the recovery continues. We were down almost 65 points. We are down about 43 odd points as things stand. So 11,527. And the recovery is broadly across the board. There isn't very much by way of... there are no laggards in that sense. Bajaj Finance, for example, has started to come back up once again. Maruti is off the lows. And I already mentioned names like Z, etc. Let me just actually put up the nifty names which are doing the best. It is Bajaj Finance. ITC is picking up once again, 1.5% higher. Cipla is up about 1.33%. IOC, so oil marketing generally is continuing to do well after the run it's had. So BPCL is the one which has done the best in this month. But that is because of, talks of strategic stake sale, etc. The question I think many would ask is, should you play that? Should you play BPCL? Or should you look at a couple of, the other two OMCs as well, where if the business continues to improve, both will benefit, even if there is no strategic sort of angle in IOC or HPCL. So we'll see where that one goes. Bajaj Finserv is up 1. RIL is participating. It's up about 1%. So there is a broad sort of wave of buying which is coming through. Okay, Ganesh Ram Jairaman is head of institutional equities at Spark Capital. He's joining us right now to tell us what he's making of things. Mr. Jairaman, thank you very much for your time. Great to have you here.
It was fine.
So first up, how are you? What's your view broadly on the market, the run-up we've seen, and where are we now?
For a couple of years we were cautious, and we had been recommending a very defensive bias portfolio, or what we called as all-weather managements were kind of dominating them. They were costly, quality companies. Coincidentally, about 10 days back, we had, a couple of weeks back, we had written a note saying the first signs of macro outlook getting better is being visible. We had been watching data for about a couple of months, and we think these have now taken some more decisive trajectory. On the other hand, we also actually said the earnings trajectory will get worse. Of course, now post-tax earnings will look better, but pre-tax earnings we still believe will have a challenge in the next three quarters, including the September quarter. So how are we recommending a portfolio stance, given these two very dichotomous things? Our assessment is the improving macro are led by 4 to 5 variables, and they will start showing up in earnings with a 6 to 9 month lag. And we always tend to use this period to start preparing for the next earnings cycle. Markets, we believe, will start waking up to it maybe 3 to 4 months before. We want to be 3 to 4 months before markets and tell the investors accordingly. What are we watching? I think the key reason is what led to downfall, what led to the fall in demand really is root causes were forex reserves falling, current account deficit going up, the fiscal challenges which were quite elevated. These all were late 17, early 18 events which led to forex reserves falling, and forex reserves falling led to liquidity shortfall in the domestic economy. The money moved out of corporates or households and to pay for the BOP. Those are beginning to improve. Forex reserves is back up. The current account deficit is mellowed down. Even if as long as oil stays below 70, we are in safe territory. We are also seeing government spend beginning to pick up. All these lead to the demand fall, which happened pretty much for about last 24 months, and that kind of triggered pretty much same week last year. The September last week was when this blew up as a challenge for NBFCs. That is beginning to improve in terms of.
By the way, your change in stance, was this pre-corporate tax cut? Or?
Funnily, it was coincidentally. Okay. It was about a week before that. Coincidence. That was really what we were not looking at. We still believe that pre-tax earnings will be impacted over the next 3 quarters, including the September. We have been seeing earnings downgrades, and that will continue. 2 or 3 more variables. If you actually understand the bond markets, consistently they've been ahead of equity markets over the last 15-20 years. If you watch data, you will always look at that and say, and the reason for that is India has a fixed rate deposits and a floating rate assets profile, which will take time for monetary transmission to kind of percolate down. Whereas the bond markets obviously wake up early, equity markets, and which means consumer demand takes time for it to happen. That's the second reason. Thirdly, we are also watching gold is up 25% in the last 12 months. India has about 25,000 tons of gold, and 70% of that is in and rural. We have been watching gold loans data now beginning to grow up about 25-30% in the last about 18 months, which means the gold price inflation is beginning to get monetized and getting converted into maybe consumption, maybe business, maybe deleveraging, and that's something which we think has a big positive effect. Okay. Also, we are watching some of the data points like commodity prices and other. So about 5 to 6 key variables which led to the fall in demand in the last 24 months are beginning to kind of self-correct. It's classic cycle. It normally would have taken 3 years. We are seeing it in 2 years. Cycles are shrinking. This is one side. On the other hand, we see earnings to actually get impacted. In fact, the tax cut of the last week will actually not be great in the short term because government spend in some form needs to take a backseat. How will otherwise they fund the fiscal deficit? That's sure. One. But more importantly, we are seeing the first signs. These are more lag effect of again last 2 years. But we are seeing the first signs of NPAs rising in the retail or the MSME segment or lower growth profiles there, and we think that will also start having an effect. We are already seeing it in terms of risk appetite, what kind of consumers.
Sure.
Our NBFC is growing.
I'm just going to interrupt you there because what about the auto space? I know you can't talk about stock specifically, but there are some massive discounts which could be expected in the auto space. They have done how much ever they could. For example, Maruti's latest was only up to around 5,000. Do you think that maybe that will be enough to spur demand this festive season? Are we going to see maybe some amount of consumption come back?
Our channel checks reveal that the enquiries have picked up. Now, whether enquiries will convert into actual sales, very difficult. And we are not expecting anyway the remainder of this year to offset the fall in the top line in the last 6 months. So we will see auto sales, be it two-wheeler, four-wheeler, commercial vehicles, have a decline this year. But cyclicals being how they are, you need to be thinking 6 months ahead of them. And our assessment is the next 6 months' time is actually the best time to buy some of these stocks. Structurally good, cyclically challenged is actually our preference. And our portfolio strategy has evolved or clearly changed in this upgrade note where the defensive stance, remain out of cyclicals, reduce our exposure to growth stocks, stay put with the defensives and time-tested track record companies. We are shifting our stance more to value stocks. Stocks which are trading at bottom quartile, bottom decile valuations, multiples based on the last 10-year traded history.
Ganesh, why don't you give us some names? Which are your top
stocks? Is something which I'm not, I cannot talk, but more sectorally, we are beginning to see some signs of value emerging in housing finance companies. In some, not all, obviously, it's very stock specific, management specific. Some automobile stocks, definitely, some industrials. So clearly, our stance, which was biased towards only the private banks, or even not all, a few of them, or even the consumer staples companies, some degree of shift we are seeing. Also pharma. That's another segment where we are not taking a sector view, but specifically 2-3 stocks, we are seeing things actually beginning to improve there. We think their managements have taken corrective action and things could look a little better for them. Again, with fiscal 21 in mind. These things will not show up, but the valuations are attractive enough.
All right, we're going to leave it on that note. Pleasures hearing your views. Thanks very much for joining in and speaking with us. So that's the view coming in from Spark Capital Advisors. We'll take a break at this point, but on the other side, a very interesting conversation lined up. Sandeep Parekh, founder of FinSec Law Advisors, and J.M. Gupta, former ED at SEBI, on concerns around the standstill pact being extended by mutual funds to borrowers.
A market leader in cash logistics,